Good morning, everyone. Thank you so much for taking the time to listen to our feedback on the Nedgroup Investments Flexible Income Fund. I'm going to start the presentation by just going through the performance of the fund and giving you a bit of feedback on where the returns for the last year and the last quarter came from. So you can see over the last year, the fund delivered 9% and over the last quarter, 2.6%. The themes are generally the same, where the offshore component of the fund, the floating rate local component of the fund, as well as the nominal bond portion contributed to returns. For the last year, the offshore component is largely due to the weakening of the rand against the dollar. As rates rose, bonds naturally had a bit of a headwind, but the fact that especially on the local bond side, the running yield of the funds was so high, the total return the running yield on the bond was so high, the total return of the bond and linker portion still managed to be positive over the last year. For the quarter, there was a nice decline in base rates, which actually meant that bonds rallied over that period. So for the quarter, nominal bonds and linkers contributed positively off the base of that. As interest rates have risen, the floating rate component of the portfolio continues to generate a very nice yield, and that has been a very nice contributor over both periods. Property is unfortunately a sector that has been struggling for a while and is a very marginal detractor. Our allocation there has remained quite low, thankfully, off the back of what has been very, very sluggish performance there. So I'll start with a bit of the global backdrop, and we called this presentation the rate whipsaw for a reason. The interest rate environment, particularly in the US, has really been very volatile. So just to illustrate that for you, if you look at where rates were, so that's the Treasury curve as at the end of December 2022. So the market was thinking US rates would peak just under 5. And then because of recessionary concerns, the Fed would start a cutting cycle and we would see rates lower beyond that. So come the beginning of the year, this narrative was very much embedded in the market where we thought, okay, rates will peak just below 5. There's a recession looming. The inflationary scares that we kept seeing last year are behind us. So we really did see a nice rally in rates, and bonds had a very good start to the year. Then, unfortunately, a bit of deja vu hit. And all of a sudden, we started seeing all those strong numbers come out the US again. In particular, we saw very strong jobs data. We saw strong retail data. And then the CPI number came out. And again, market worries about sticky inflation. And all of a sudden, the yield curve moved into an incredibly hawkish positioning where the market started thinking, actually, the Fed is going to have to do a lot more. And they started pricing that the rates might peak actually just below 5.5. So if you look at the whole inflationary dynamic in the US, we are seeing headline inflation moderating largely off of the back of fuel prices and energy prices coming down, but it really is that core component that is remaining incredibly difficult, particularly when it comes to shelter. Shelter inflation is sticky, it's high, and that is, of course, driven by the fact that the labor market just remains incredibly resilient in the US. We saw a high 400,000 print in NFP data for January. We saw another high print for February. And even though March's print, which recently came out, was slightly more moderated, it's still not nearly at the level where you would start to think that the US economy is going to slow or even moderate at a very reasonable pace. So there is this concern that inflation, particularly the core component, is going to stay higher for longer. And the market reflected that fear in its pricing at the peak, which was in March. And then came the big news for the quarter, the bank failures, the second largest bank failures in history. And all of a sudden this news came out and the market started thinking, okay, well, at the peak, they might have to do 50 basis points in March. Now actually they're wondering whether the Fed can even do anything. And you saw that yield curve move all the way down again. So Come the March FOMC, we had, like I said, a move from a 50 basis point expectation to then can they do anything? In the end, they delivered what was probably a largely consensus and a more neutral 25 basis points, but their tone was definitely more dovish than what we have seen in previous meetings. It was, however, not this big pivot that I think some market participants were hoping for. They still remain quite dedicated to their view that inflation is still too high, rates need to remain higher for longer. So if you look at the dot plots that came out after the Fed meeting, you can see that they are importantly still not viewing any policy easing to happen this year. And that is in direct contrast to the market, which thinks that they will be easing later on in this year. So let's just spend a bit of time talking about these bank failures, what it means, why it happened. And, a lot of parallels were drawn to 2008, which is not correct. This is not a credit crisis. This is not off the back of banks holding assets of poor credit quality. The risk here was off the back of duration and liquidity. So we can rewind back to what happened in COVID. We had interest rates being cut at an exceptional pace to the lowest levels ever recorded, and we had QE done on a scale never seen before. So the system was essentially flush with cash. So as banks were receiving all these deposits, what do banks do with deposits? They have to invest them. They have to turn them into assets. So what happens is that generally they buy treasuries, and at that point in time, they were buying large amounts of treasuries, typically long dated and at very high levels because of this record influx of cash. This generally doesn't matter. So even now, as interest rates have been rising at record pace, these instruments are held to maturity, so the banks don't have to mark the losses on these maturities at all. They are just marked as held to maturity instruments. At the same time as rates were rising, you unfortunately also had quantitative tightening happening. And what does that mean? It means that the Fed is letting treasuries mature off their balance sheet and essentially destroying bank reserves. So the amount of cash in the system from that point of view is also becoming low. So as you can see on the right-hand chart, the cash that banks had as a percentage of their total deposits was moving to very, very low levels. And this was very exaggerated when it came to the small, medium-sized commercial banks. This dynamic is what eventually caused the failures of Silicon Valley Bank and Signature Banks, and later the stresses seen by Credit Suisse. Big mark-to-market losses, low cash ratios. As depositors start worrying about this dynamic, they start pulling deposits in order to meet that cash. These large unmarked losses need to be realized, and eventually the banks move into an insolvent position. We do have to note, though, that although this dynamic is quite common in banks at the moment, it was banks that had this dynamic to the extreme and that had a rather concentrated depositor base, that this happened to. So the big concern immediately is there contagion risk? What you don't want is people to panic and draw large deposits out of banks off the back of this. So the Fed and the Treasury came up with a very neat solution, which they called the Bank Term Funding Program. And basically what banks could do is they could, instead of selling these instruments that are held to maturity, they can basically post them as collateral to the Fed, and they can get a loan of that side with those treasuries as collateral at par. So it's a nice, clean solution that limits the contagion fear around this. And although it doesn't solve the underlying problem, it definitely does mean that this problem wouldn't be as systemic and as long drawn as what it potentially could have been. So we don't think that this is reason enough for the Fed to pivot on the back of what is still very high problematic inflation. Turning to the local side, the title of the rate whipsaw is still pretty pretty apt for what happened in local markets. Generally, market participants have been very good at calling what the SARB, what the MPC will do, and this quarter we were, I think, all caught by surprise. The market was very consensus that there would be a 25 basis point hike in March, and we were surprised by a 50 basis point hike. So you can see pre-MPC and quarter end just how much the yield curve had to adjust off of the surprise. So not only was it a big hike, it was also quite a hawkish statement from the MPC. Their reasoning is inflation, and yes, we can see inflation is high if you look at the right-hand chart. And again, the problem is coming in the core basket. Food prices are remaining quite sticky. A lot of that does have to do with load shedding. And then we're seeing other components like health insurance, hotels, those kind of elements of the basket really pushing up that core number. So their messaging was their concern around a concern around expected inflation. So the market's expected inflation has moved too high, and increasing rates will offset that. The difficulty with that is that, it's correct signaling, but this is not demand-side inflation pressure. Raising rates at this point in time is not really going to do much to appease, the elements of the basket that are really driving core CPI higher. So our suspicion is that the SARB is probably more concerned about the rand and the effect that the rand has on inflation. So why are they concerned about the rand? Naturally, a weaker rand does come through in the inflation number. But the rand is weak, right? And if you look at our left-hand chart, that is the rand valuation model, we believe the rand is trading weak here. But there are a lot of further weakening pressures on the rand, and we believe the SARB is very aware of this. Why do we say that? Well, firstly, the current account surplus was always a big tailwind for rand strength, and our terms of trade are now reversing, and that is probably going to be in deficit by year end. So current account deficit, the fiscal relief that we've been so used to off of the back of higher revenue collection, we believe that is also coming to an end. So I think the wider fiscal deficits are what the market's going to have to get used to again. And if you look at the right-hand chart, the carry of the rand versus the dollar, just given where US rates are, is probably around a 20-year low. So all these components are short-term weakening pressure for the rand, despite the fact that on a pure valuation basis, the rand is cheap. Why do we think the rand is cheap on a pure valuation basis? If we just depreciate the rand by the inflation differential between us and our trading partners, it should probably be closer to the 16 level. But as we know, the rand is a volatile currency, and these shorter-term pressures could take its toll. Looking at the yield curve, where do we think bond valuations are? So last quarter, or Q4 2022, bond valuations were looking exceptionally attractive. There was a very, very fat risk premium baked into bond pricing, and that has reversed to a large extent. If you look at our bond valuation model on the slide, if we imply or if we back calculate what the implied risk premium is, it looks that it's like just around under 4. And that, in our opinion, is probably just around fair value. But there are two things we want to point out. The US 10-year at 1 is good value, in our opinion, and the SA inflation number of 5.5 is probably on the higher side. Pre this kind of inflationary bout, I think long-term inflation expectations were probably moving towards the 5 handle. And now that we've had this period of slightly higher and extended inflation, it's probably moved to 5.5. But we do think that over time, that expectation will move back down towards the 5 handle. So in all fairness, it's probably on the cheap side of fair or on the expensive side of cheap, however you want to phrase it. it's also a time in the cycle where you don't really want to be letting go of your duration. In all likelihood, we are at the top of the hiking cycle. And yes, rates might stay here for a bit longer than what the market's thinking, but typically it's a good time to hold on to your duration. So, it is still an instrument that we like. Our preference is on the nominal side versus the linker side. The break-evens, particularly on the belly to longer end, are still very high. So in general, although we still hold some short-end linkers where we think there is still a bit of value, our preference remains on nominal bonds. So just to give you a bit of an overview on what the portfolio looks like, this is just the yield pickup over the benchmark. The yield of the fund is currently at about 9%, a nice pickup over cash. And you can see that over history, this fund has managed and continues to manage a good sustainable pickup over cash for its investors. So what does the portfolio look like? We've got 37% exposure to floating rate bonds. This is a very nice portion of the portfolio. We've managed to get a pickup of about 1.8% over money market. It's a bucket of the portfolio that we work very hard in trying to extract yield, especially given as vanilla credit has remained expensive for a very long period of time. Our duration is sitting at 1.3 years, 0.9 years of which comes from the SA fixed rate bucket. That's predominantly govies, and we are very much in the belly of the curve there. It's got a nice roll down, and it doesn't have that much of the fiscal premium that the back end of the curve has baked into it. So it is a part of the curve that we continue to like. We've got 13% in linkers. These are all short-dated linkers, not contributing hugely to duration. As you can see, that's only 0.2 years. And then if you look on the offshore side, that is a part of the portfolio that has increased over the last little while. What's nice is that our offshore duration still remains quite low. The inversion of the yield curve, the US yield curve, means that we can actually pick up offshore bonds at very, very attractive yields, but we don't have to take that much interest rate risk. So if we are wrong, calling the top of the interest rate cycle, it doesn't matter so much. We have added a few instruments with slightly higher duration there. We did manage to get good levels, but like I said, we have not moved the duration of the portfolio that significantly, as it is ultimately an income fund and we aren't looking to take disproportionate amounts of risk. From a hard currency point of view, our exposure is 4%. That has come down over the last few months. As I mentioned, there might be short-term pressures on the rand, but from an overall valuation point of view, we do think the rand is cheap. So we would ultimately prefer to hold slightly more rands than hard currency, like dollars, for example. But having hard currency exposure does protect the portfolio into further bond weakening, and should the real kind of hard landing recessionary global concerns come to bear fruit at some point. So it is an exposure that, although we have decreased, it does provide a nice hedge to the portfolio. And I think that is our presentation for today. Thank you very much. So the first question, how do we incorporate concerns around South Africa, low growth, load shedding, large deficits into our investment approach? So the way we incorporate these concerns is to make sure that whatever instrument we buy has a decent enough risk premium attached to it. Risk premiums are very difficult as they are subjective, but our experience and looking through history has kind of given us an indication of what we think is an appropriate risk premium to add. So when I went through the bond valuation slide in my presentation, you will notice that we back imply how much is being added as a risk premium, and we will decide if that is sufficient or not. When it comes to valuing the rand, for example, we actually penalize the valuation given how big our fiscal deficits are, where our current deficits are, and all of those considerations do come into our valuation approach. So it's all about making sure that whatever we buy has a sufficient enough risk premium, and that the risk return profile, that there is a skew in our favor. We are not looking to buy expensive asset classes or asset classes where there is not an appropriate risk premium. We want that asymmetry in our favor. Second question, in this high inflation environment, why are you not more constructive on inflation-linked bonds? So I think the answer to this question is that high inflation expectations are already priced in. The market has become very used to this, inflation overshoot environment. And you can definitely see that when it comes into the pricing of linkers. Kind of looking through a cycle, looking at the long-term break-evens, those break-evens are still high. And, if through a cycle those break-evens are still high, our preference would still be on the nominal side. Inflation-linked bonds are also slightly different animals to nominal bonds. There are two very serious considerations when it comes to buying linkers. One, they are higher duration instruments, so you are taking generally more interest rate risk when you buy inflation-linked bonds. And two, they are significantly less liquid than nominal bonds. So given the fact that the valuations are on the expensive side, that the market is largely expecting this high inflation environment to continue, and you've got the higher duration and liquidity considerations, for all those reasons, we are probably more constructive on nominal bonds at this point in time. Okay, third question. What floating rate opportunities are you seeing in the market given that vanilla credit seems to remain expensive? So building the yield of our floating rate portion is something that I mentioned we work very hard at. And I think one of ABAX's skill sets is note structuring. So, for example, we would look at buying offshore credit and swapping that into floating rate credit, and then again also swapping the hard currency into rands. And generally, if you're able to kind of do that structuring, you can see a significant pickup than what the vanilla credit market is pricing. You can look at dislocations in the forward points market on the rand. You can look at where CDS markets are trading, and you can do structuring around that. The important thing to note with structuring is just to understand the risks embedded in those. Notes like CLNs, particularly trigger CLNs, have large amounts of currency risk embedded in them. So, you do need to invest in these kind of things with prudence. You need to be able to price them. You need to be able to understand them properly. And I think that is one of ABAX's advantages, in that we do have a very strong team that knows how to price them, understands the risks behind them. And we are able to engage in this market prudently and extract some yield that a lot of the vanilla credit market is not able to. Fourth question, you speak a lot about our view on the rand, but what is your view on the dollar? The dollar is an incredibly hard currency to call. We can do a PPP valuation like we did with the rand, and we can tell you it looks expensive. And I think that's a very consensus market view, that the dollar looks expensive. Granted, it's not as expensive as it was Q4 2022, but it is still looking on the expensive side from a pure valuation approach. But the dollar is a different creature. It is not only strong because, there is a lot of strength coming out of the US economy, there are high rates coming out of the US economy, but it also acts as a risk-off instrument, where if this global recession hits, yes, the US economy might take a beating, but it is actually a risk-off instrument. So, contrary to one's expected behavior of the dollar, it might actually strengthen in that scenario. So, a short-term view on the dollar is very difficult to make. We are more comfortable to say that through a cycle, it looks expensive, and through a cycle, the rand looks cheap. And I think that is the only call we would be willing to make. But we are not 0-1 investors. Everything is on a spectrum. So, we believe that we will do well should the rand continue to weaken. But we also do not have that much invested in dollars that it would severely penalize the fund in the case that the rand strengthens significantly.